John Gatewood with Gatewood Wealth Solutions. Welcome back to our weekly market commentary broadcast. And with me today is our Chief Investment Officer, Aaron Tuttle. And welcome back to you too, because you just got back from vacation.
Well, it wasn't vacation. We just took a little quick trip down to Tennessee. We worked remotely. I guess I took a day off. But.
Well, we do allow you to have a time off sometime.
Sometime, right?
Not
on Wednesdays, though.
But wow, what a week this was. I mean, we had the president came down with coronavirus. I mean, who would have thought, because of all the protocols that they take there. I mean, if he can get it, anybody can get it.
You know, I was
sure.
looking back on just 2 weeks ago. I'm like, wow, that was only 2 weeks ago. It feels like an eternity. It's just been, it's I guess, back to that saying that weeks when decades happen.
It is, and we're going to have the vice presidential debate tonight. That'll be interesting to see. And you know, we've got the stimulus news. We'll talk a little bit about that. We've got Judge Barrett, who's going to be going through the confirmation process. I mean, this political unrest or political uncertainty is just amazing. But you know what our job is to help sift through all that noise to really know what is this going to mean for our client portfolio. So
well, there's certainly a lot of noise to sift through.
There is a lot of noise. Well, let's talk about where we are in terms of our timeline that we talk about each week to make sure that we're kind of tracking that.
Continuing to track for this quarter the manufacturing index. We'll get into it on the GDP slide, but we've had some positive news. Still seeing a lot of growth. Despite some of the concerns on high frequency data, those indexes continue to move up, so we continue to follow that timeline. Hopefully we'll see a green whenever we get into 2021, where we really start to move out of that bear market and be in a solid bull market at that point.
So we've certainly had October surprises. Let's talk about the latest one.
The 72 hours of
the 72 hours surprise.
Yeah, so it's been interesting. I don't know how many times I've changed this slide as I'm preparing, and then we traveled on Tuesday, and I was putting this together on Monday, and Tuesday morning I'm like, well, I don't know what I'm going to add to this slide, but we got some nice bookends. We got the thumbs up leaving and the thumbs up back within 72 hours. So yes, President Trump tested positive for the coronavirus. Some uncertainty on when that actually happened versus when it was announced. He did spend some time at Walter Reed, as well as taking the vehicle that's hermetically sealed out to see his protesters. So he used it certainly as a photo opportunity, as well as some statements by the doctors that really. There was just a lot of hand-wringing back and forth, as well as well-wishing from this whole event, let's call it, during that 72 hours.
Well, so this has certainly caused a little bit more uncertainty from the political perspective, but statistically, do you think that makes an impact on the market given his age, and what are the odds of him actually having a bad end?
Well, Dr. Atlas came out right away and said that he will have a strong recovery, he would do well, but whenever you look at the odds for an individual,
right?
For an individual, there's a 3% chance. Now, if you have 100 people, that means three people are going to die. So from just a one instance, you could come out and say with a strong conviction that President Trump would make it through the coronavirus. There was a lot of different experimental drugs that he was given access to. One of them was for when your immune system is not responding well. Now, was that experimental, or was his immune system not responding? We don't know. There's a lot of ambiguity and a lot of ways that you could hedge your bets and come out there. So there was a lot of uncertainty, but we think for one individual, the likeliness of President Trump surviving the coronavirus is very high statistically.
So let's just say that he does survive, and of course we certainly hope that he does. We wish him well. How will this help him or hurt him in the polls, which he's been trailing?
Well, if we look back, anytime there's some type of incident that happens to a leader of a nation, there's usually a knee-jerk patriotic response. You can think of when Reagan was shot, there was a lot of well-wishers for people that were very adversarial towards him. They came out in support. And we can just go to Boris Johnson, who contracted coronavirus and really struggled with that, the illness, and his approval rating did increase. So maybe it wasn't wise for Trump to only be at Walter Reed for 72 hours, because it seems that the stretch that Boris was dealing with the coronavirus, his approval ratings went up, and then after he passed that time of severity, they began to drop. So we think that is also likely that Trump did get a slight increase. He was only there for 72 hours, though, and it looks like he's doing well, despite there was some, I guess, rumors on Twitter based on Kelly Conway's daughter's response saying that he's not doing well. Who knows the reality of that? That a teenager probably does have some decent access to relevant news, but once again, it is a teenager.
Well, one thing that has not slowed down are his tweets, and what else has not slowed down is the message from the tweets in terms of not being consistent. Let's talk about that.
Well, we're still trying to struggle on whether the stimulus is on or off, and this was our original slide.
Well, I just looked at the Wall Street Journal before I came out here just to check. I think we're back on.
Well, you don't know what's happening right now, the way that this is moving. But while President Trump was at Walter Reed, he said, "Hey, we need to get the stimulus done." And then if you look at Mitch McConnell, one of the things that we think is preventing this is the Supreme Court nomination of Amy Barrett, and that the focus. The Democrats have passed the stimulus bill. Seems President Trump in this tweet wants it to go through, but the Senate Republicans, led by Mitch McConnell, is more concerned about the Supreme Court, so we thought that wouldn't go through. And then this was an added slide because it came out that, yes, Secretary Mnuchin and Pelosi, House Speaker Pelosi, were talking about and trying to work out the stimulus, but then we had a tweet storm from President Trump saying it's completely off. Now we're back on. This was October 6th. Now we're in October 7th, another decade away, right? So we don't think it's likely to go through because of the focus, before the election, because of the focus of the Supreme Court nominee.
So how will that impact the market, and is that changing anything in terms of the way we're looking at portfolios at the moment?
Not at the moment, because we don't think it is going to go through. We could see that yesterday the market is pricing in the likeliness of at least the probability of the stimulus. We did get a sell-off yesterday on the news that the stimulus wouldn't happen. We know the Federal Reserve is asking that they do it because where we are on monetary policy, they say they don't really have any new tools that they could add. We're at the full extent that monetary policy can do, and we need fiscal stimulus. So the market is certainly going to sell off if the likeliness of a stimulus decreases, but we think most of the odds of it not passing are already priced in the market. Let's say that there's a 10% likeliness that it would go through and a 90% likeliness that it wouldn't. Well, if that 10% is reduced, you're still going to have a market sell-off. And whatever the odds are, we think that was what was happening yesterday.
Yeah, one of the interesting points I was thinking about Donald Trump's tweets, and then going back and forth on what he's saying, is I read the book Rage by Bob Woodward, and in there he interviewed Jared Kushner. And he was talking about what it was like trying to manage his conversations with Donald Trump. And he said, well, you have to understand, he is a deal man. Mm-hmm. He pivots whenever he hears new information. So don't go in, give him information, and expect him to stick with whatever he tells you he's going to do, which is kind of an interesting concept, when you think about here's a deal maker. But it does make it more interesting for us and the market to try to figure out, how are we actually supposed to respond to these tweets?
No, it's one thing that we have not been able to factor in whenever we're thinking about it. It's not that President Trump is operating out of principles, whether it's a free market, which I would actually think that he's not very free market as somebody that's advocating trades and tariffs. I know that he's come out to say, well, that's because I am for free market. I'm trying to negotiate so that we can get to a freer trade. But it's really not about some hard principles that he's following so that you would know beforehand. I do think it's more of the art of the deal. He's gonna make sacrifices and compromises left and right, whether they go against some specific agenda whenever his goal is X, Y, Z. So it's made it very difficult to really anticipate what is going to happen.
Well, one of the things that we do think is going to happen is that we are going to have a contested election. I mean, I would say that's probably what most people feel. How do you see that?
So we would agree with J.P. Morgan that is, whether we have one or not, we think that's the most likely or the baseline scenario. And J.P. Morgan had a great slide of just showing, because the contention is about mail-in ballots and what that does for the elections and the uncertainty that that brings. And we can see historically, mail-in ballots have been happening in a lot of states. Many of the states have not had issues. Once again, we see the issues really coming for just some tight races, but we do think that there is the likeliness of a contested election at this point, and agree with J.P. Morgan. With the ultimate concern is, what does that do to the market during that period where it's really uncertain after the election to whenever we finally know who will be the president. And a lot of people have been asking us on, what do you see during these things? How do you position portfolios?
We've talked about this a little bit, but that is a question that we continue to get. Depending upon who's elected and whether you have House and Senate, what is going to happen, and how would we be positioning portfolios?
Absolutely, and continuing on, let's look at a cross-asset recommendation for the White House, who wins the White House versus who controls Congress, whether it's divided where Democrats hold the House and the Republicans hold the Senate, or the Democrats control the House and the Senate, and then who is the president. And if we were to look at that first top left column, where you have a President Biden with a divided Congress, Senate Republican, really it's status quo. There's probably not going to be any changes to the tax law, and this would be probably that Goldilocks scenario where there's not much that the government actually can do or disrupt. So the rules of the game are pretty much set, at least for the next 2 years, until there's another election. And in that scenario, you really want to favor the U.S. We have lower corporate taxes now. There's been a lot of stimulus that's created here. Our recovery has been pretty rapid relative to other countries. In that scenario, where you have a Senate Republican and a President Biden, we would favor the U.S. equities. Let's say if we have a President Biden and a House and Senate controlled by the Democrats, that's probably going to be a large infrastructure spend. So in that case, you want to favor things that are going to do well in inflation, things that would be in demand for infrastructure. So basic materials, base metals, things that are going to deal with that construction. You probably also want to have some inflation hedges put on, because I think both. I get frustrated with conservatives who say they want small government, low spending. I think they're just as big of spenders.
I haven't seen one shrink their spending yet.
Yeah, exactly. It seems that no matter who is elected, if they get 8 years, the national debt doubles. Doesn't matter. If that happens, we do think that there would be a lot more spending, higher wages, etc. So inflation hedges would be warranted. Well, let's go the same thing with if we have a President Trump, Republican Senate. You really, there's going to be a lot of trade disputes. Once again, we don't think that President Trump is at free market. He's actually about restricting trade. A lot of people advocate whether that's good or bad, depending on the situation. There's arguments to be made for sure, but we would not want to have a lot of exposure to emerging markets or emerging market currencies, because we think that they would be impacted more. The other thing is, the market's probably going to be very volatile. There'll probably be a lot of swinging back and forth between equities, because the market does seem to be pricing in a Biden election. We can get into those polls here in a little bit, but that's what we would see if it was a Republican Senate and a President Trump. Well, let's go the Congress, both Senate and House are controlled by Democrats, where we have a President Trump. I think impeachment proceedings are the big risk there. They're probably coming back on. So if that was the scenario, there's going to be a lot of chaos. You want to be out of U.S. dollars, probably holding Japanese yen. They tend to be the best risk safe haven outside of the dollar. Actually, holds up better than the dollar, as well as being maybe in the euro, as well as gold. But we think the baseline scenario, the bigger base, is the likely to have a contested election. In this scenario, you want to have overexposure outside of the U.S. because during that chaos, it's mainly going to be U.S. centered. So it'll be a drag on the U.S., but it probably does not have a significant impact on global growth. So at that point, you want to have some access to global growth. So a lot in this slide to cover.
So don't you think that volatility is really going to be really more short-lived in terms of the uncertainty of that outcome? But eventually, we'll figure out who is actually elected, and then that will then give better direction to the market as to which of these four categories would actually play out.
And if you look at our portfolios, we're actually covering each one. I know that the polls indicate that Biden have seen up to 14, and recently CNN had a poll of 16 points. There's oversampling of Democrats, and typically that's for good reason. It's really hard to get the blue collar vote that tend to be Democrats, so oversampling Democrats does a good job of catching that proxy. It's a little bit different whenever you have a populist candidate, especially if that populist candidate is on the conservative side of the ticket. We saw this in 2016. We saw this in Brexit. This is where we think the polls tend to be off. We're not saying that Trump is having a landslide victory or anything like that. We're just saying we believe the election is a lot closer than what these polls indicate. So we've really hedged our bet across this different thing because though we think that contested election is likely, it should be short term, and you can make a case for either or. So we've been trying to find asset classes and securities that would do well really under any of the scenarios, so that we're not making a big bet that could come back and really hurt the portfolios. We're kind of taking a more middle of the route and trying to find things that would do well in either way.
So let's talk about Biden and his tax policy that's been proposed. I mean, that is, as you have here on the research that LPL has done, that this will be the second largest tax increase historically. Can you talk about that a little bit more?
Yeah, I want to preface this slide with liars figure and figures lie. It's probably more than
I think we should do that for every
right,
every slide we put up.
And I don't think LPL is doing anything disingenuous or trying to skew anything. I think they're doing a legitimate research and trying to understand it. So what they're looking at is how a tax increase relative to GDP. And there's all kinds of things, the numerator, denominator, on how this could be misconstrued. One, we're coming out of a recession. What does that mean for the GDP whenever you're reflecting at it? So take this with a grain of salt. But President Biden has been out there saying that he would increase taxes. And based off of that research, looking at this type of comparison, it would be the largest tax increase other than Lyndon B. Johnson. Now, why isn't the market selling off because of this? Well, there's a lot of other things that are going to counter a high increase, and one is the infrastructure stimulus that we talked about earlier. It's likely to see higher wages. We would likely see dampened trade tensions, so it would not be so contentious between the Eurozone and China and the U.S. with trade. So there's a lot of things that can counteract and offset some of the tax drag that would be in there. So we don't think it's the end of the world for GDP or the markets if this was to happen, but we are recognizing that there could be a tax increase, especially in that scenario where the Democrats control both the House and the Senate and President Biden.
So let's move on to the coronavirus. So we've talked about this incessantly
yes
for the last
I'm glad
7,
it's getting
8 months.
Further down.
Boy, no kidding. But
though what the election has not been that fun to cover either.
It's been, well, it's certainly given us stuff to talk about each week.
Yes.
But so the cases are still
the growth
somewhat up.
The
but
growth
the deaths
is
seem
still
to be
positive,
down.
but it is slowing. It does look like that has happened, and a lot of it we think is for the U.S. is really just the increased testing. It correlates very well with this pop, and so far we have not seen an increase in deaths, which really that's the litmus test.
Yes.
Because you can increase tests, and you should increase positives by simply increasing tests. So the big tell is, are deaths increasing? Now, we did this weeks ago where we lagged and said, well, it tends to take 2 weeks, and it took 4 to 5 weeks before we actually seen an uptick in the deaths. So it's still too early to call based on that experience. We have not seen the increase in deaths as of yet, but once again, last time we were looking at the lag, it took 4 or 5
Right.
weeks for the information to show up.
Now, how do we compare with other countries and in terms of their experience right now?
The U.S. is faring better, and that's because we just have had more positives than others. We were not as stringent on our lockdowns as the lockdowns are being relaxed, and for all indications are that the Eurozone does not want to bring in strict restrictions again. And we've used Sweden as kind of the proxy for the U.S. There was a slight uptick a couple of weeks ago. It lagged the other countries on their uptick. It's since been trending down, but we're starting to see France also trend down as well. There are some lockdowns that are being reinstituted in the U.S. New York has been an area. For those that are following it, Governor Cuomo has said that he would close the churches and the synagogues, and there's actually a big protest by the Orthodox Jews against this. So there's a lot of political items to deal with on these lockdowns, and it doesn't seem that there's a lot more protests than there were on the initial one. So we would think that the lockdown is less likely going forward.
So how are we doing from the GDP growth?
So still positive at 14%, and we've kind of maintained that. Once again, we think we're not going to grow at 14% in the U.S. We're a mature economy, so we do expect to see this go down. But as mentioned at the very beginning, the ISM service index is up at 57.8%. Anything above 50 is strong. So to see 57.8 is good news. Business activity index is also up at 63. That's a very high number. New orders index is also increasing at 61.5. The employment index is up as well. Now, it doesn't mean that it's all a rosy picture. The business confidence continued to fall for the last 4 months. We think a lot of that is the larger companies are doing well, but a large amount of small businesses are in the retail space, in the restaurant industry. We've talked about the airline. So there is a lot of uncertainty and ambiguity and not long-term planning for these businesses. We've talked about that. So once again, we're not putting on rose-colored glasses here. There are still problems to deal with for sure.
So there's been good news then in the market.
Yes.
You know, but then the question becomes, because we have these discussions on stimulus, and we're still dealing with reopening the economy. Which of those two would really be the best for the market going forward?
So just saying the goal of market, taking out any of the other considerations that would have to be dealt with in a multidisciplinary approach on trying to figure out cost benefits, the market would definitely do better with a reopening, probably a reopening with fiscal stimulus. I think that would have a lot of problems with inflation long term, but we'd certainly see a bigger impact if you dumped a bunch of money on a reopening economy. But if we just do stimulus, 3 months down the road, we're going to have the same problems. Right? Ultimately, wealth is done through production. We got to get people back to work. That's sustainable long term. Fiscal stimulus is not, and so we think a reopening would be better. There has been slowdown. We've talked about the unemployment numbers for quite some time. There were 661,000 jobs created. That is a decrease in the amount of jobs. We continue to slow. We did get positive numbers of saying the unemployment is below 8%. Consensus, I think, was 8.2 or 8.3. But if you really dig into the numbers, it was more just things falling off. We don't think that was a true picture, and we are concerned about the sluggishness of employment. And a lot of these businesses, especially the small businesses that are going out, it's not just a quick phone call and you call your employees back and they start back up like we had at the very beginning. These people are going to have to find new work. Those businesses are not going to be reopened, and it's going to take some time. And we think the unemployment numbers, even to have a positive headline below 8%, is very concerning. It is sluggish for this time.
Well, we've had some additional good news that we touched on in the prior weeks, and that's home prices.
Yes.
And even the supply of homes being very, very low.
Right.
Let's talk about that.
Yeah, so that's been one of the great places to be through this entire recession is home prices. And the affordability index is actually saying that homes are more affordable. Well, why is that? Well, one, mortgage rates are at near all-time lows. So borrowing to buy a home is much cheaper. And the people that are out of work and that have been hurt the most tend not to be homeowners. It's retail, it's restaurant businesses, salons. So it really hasn't affected a lot of the people that are doing home purchases. They've been able to continue working. And for the last few years, wage increases have outpaced inflation. That means that they were actually growing in their income. Despite the recession, we've seen that income move up over the long term. That means housing is more affordable, and there seems to be a lot of demand for the housing. So being demand, we're looking at a housing supply, and housing supply has been very low. So you have demand, especially as people are trying to leave a lot of the urban areas, leave apartments, et cetera, because they want more space. Chances of lockdown certainly have increased. If they get locked down, they want a bigger home. And the affordability through mortgage rates and long-term higher wage has certainly helped this area. And then the big question is, are we in a bubble? And one of the better ways to determine that is to really just look at the lending standards. And we haven't seen the lending standards of pre-2008 where it was ninja, no income, no job, no assets, just get them through, push them through, the house will always appreciate, we'll cover our losses. That has not been this, the thing that we've seen in the data. And this is, I want to make sure that they don't think this is our data. So this is all slides from some research that we received from Goldman Sachs on the home. So affordability is there, supply is down, and demand is up, and it doesn't look like the lending standards are very loose. They seem to be pretty strict. So this has been that one bright area through this recession.
Well, let's talk about mortgage rates too, because we have the Fed is now talking about holding interest rates low. So I assume that's primarily the short-term rates, right? But since mortgages are tied to long-dated bonds, right? It's a long-dated note. Do we see those going up while the Fed holds the short-term rates down?
Well, so whenever we talk about Operation Twist and a lot of these new policies where they're going out and they're able to buy ETFs, it's not just the short side. It used to be that the Fed controlled the window and the short-term rates. They had no impact on long-term rates. You had things like bond vigilantes that would be able to prevent the government from borrowing because they could raise the rates by just abandoning the market. That isn't the case anymore. The Fed's new tools allow them to go further out on the curve and be able to purchase government securities. They also purchase mortgage-backed securities, and they're even in ETFs at this point. So we think the Fed can control it because they have a printing press. They can print as much money as they want, and they can buy these securities at any price they want to pay. If they want interest rates to be negative, they can make the interest rate negative. And it doesn't seem that they want rates to be very high at all. Now, they have increased a little bit. The yield curve has increased. Whenever you look at the 2-year Treasury versus a 10-year, that spread has widened, which tends to allow banks to create money and lend out themselves. That's a component of the money supply. So we don't see a sharp increase in interest rates, and we think the Fed does have the tools to prevent that from happening. Whether it's wise to do that or not, I think it's debatable. We would come on the line that it's probably not. 12 individuals is not nearly as informed as the overall market on where interest rates should be, but they do have the tools.
So speaking of money supply, we continue to see the money supply drop. We were talking a little bit last week. Is this a concern, since that's one of our technical
It's a key
spots?
indicator
It's
for
a
us.
key indicator.
Yes.
So where are we and what are our thoughts right now on the money supply?
Well, there was a massive amount of money created through the crisis, and we've been talking about it. It's like a pig going through a boa constrictor, right? It's just kind of moving through, and we're on the other side of that, and we're seeing a substantial drop in the growth rate as monetary policy looks more normal, I guess. But it's still very positive. It is growing nominally, and that's why we're starting to see that right side of that bell curve kind of drift out. As well, if we're looking at 52-week, it's beginning to be positive again. And if we just look at basic numbers, we're seeing growth in the money supply. The drop in the money supply is one of the reasons we added portfolio insurance, one of the reasons we left convertible bonds for the Barclays Ag and took some of the risk out of the portfolio. Raised 36 months of cash for those that need cash for retirement. So we are cautious because of this money supply, but we don't think it is a panic mode at all. If we start to see this increase, we might actually want to add some risk back on as this kind of goes, as this pig makes its way through, and all of a sudden we see 10 or 12% growth, which is huge growth. It's just nothing like the 60% growth that we saw whenever all of this money was created.
So let's talk about the market. Where are we in terms of the S&P pricing? And
so the market has been selling off since the money supply had started to slow, and it broke through that wall of worry, so we haven't been climbing the wall of worry. Maybe a new one is starting to set in. Once again, we want to see some positive numbers on money supply. We think we're a few weeks out from that, but we also don't see a lot of downside potential here in the market, especially the Fed would act. Fiscal stimulus will immediately be passed, we believe, if there's all of a sudden a market correction or some turmoil in the market.
do you think that we're overpriced?
Not based on where interest rates are in Fed policy. Are we overpriced? Historically, Case-Shiller, PE, absolutely, but we have it used to be called the Greenspan put and then the Bernanke put. The Fed is going to act. So no, I would not abandon the market because there is artificial stimulus that the government can do to prop up prices. We think that's a bad idea. We think markets are supposed to be price discovery, but the Fed is there. So no, we're not too concerned about the price at the moment, considering all the variables. And if we were to see 3,062, which we kind of see as kind of the bottom here of a correction, we would be buying that correction.
So we're just finishing up the quarter.
Yes.
And so how did asset classes do?
Certainly. So one thing is this does not take into consideration yields like dividend income, and this is just price return. But if we look at the previous quarter, the NASDAQ was one of the best performing. That's this solid red line, and it did very well. The S&P 500 is blue. We also have the emerging market, which is, I believe, black. So things that did well, things that we over allocated to did really well. As an example, the red bar on the right, that's just saying, well, let's make the S&P 500 neutral. What did better than that? What did worse than that? You can see our tech allocation last quarter really helped, favoring equity over fixed income. The U.S. Ag was actually negative on a price movement, not income movement for the quarter. So once again, that means bonds lost money last quarter as a price. And relative to the S&P, or favoring equities certainly helped our portfolios.
And then we also have the style of investing.
Right.
Though that has gone back and forth a little bit.
Right, and if you look and read most textbooks on modern portfolio theory, they say you want to be value, you want to be small cap. These will always outperform, except over the last 20 years. That seems to not be the case. You want to be in growth companies. That was certainly true last quarter. If we look at this, red is the S&P 500, blue is value, and green is growth. And then if we neutralize that and make the S&P 500 just neutral, we can see value certainly struggled relative to growth. Another reason that we had a lot of excess return in portfolios over the quarter is because, being tech, we have favored growth, and we favored growth across all asset classes. So value continues, everyone continues to wait for this rotation. We believe if the Fed is going to keep interest rates low, then they're going to continue to favor growth style because their earnings are out in the future, and they usually project really big earnings. Well, they're basically saying that those future values are worth just as much today as they are tomorrow because the factor that you're discounting is so small.
Right. Well, the lower the rates, the more favorable it is to invest and grow the company.
Right. Absolutely.
So let's look at the whole year. So we were looking at the quarter. How have all those asset classes performed since the first of the year?
So since the correction, we haven't had a negative month. So if you look at this green box, we've continued to climb that wall of worry. And for the quarter, we were positive. That's not true for the month of September. That's our first negative month since the March sell-off. And you can also see most of the U.S. asset classes, the small and mid, have actually, for the year, not done as well as their opening. That's not true for growth stocks. That's not true for the S&P 500. But more concerning to us is that negative September. Does this mean that we're moving into a downward market? That's one of the reasons we put on portfolio insurance. We also think long term that the market will continue to move up. We just have a lot of turbulence right now.
Now, there's been a lot of talk about gold.
Yes. So if we're looking back to March, whenever we're looking at the equity asset class, and a lot of people think gold is not a good investment, it's just a rock, it just sits there. Well, for 8 quarters now, gold has been positive each quarter. Doesn't mean that they don't have months that are negative. Last month was negative for gold, but on a quarter basis, gold has significantly outperformed the S&P 500 over the last 2 years, and the S&P 500 hasn't done horribly over that time. It's up 20%, but gold would be up 55, 60% during that time frame.
So the dollar's another thing that we keep looking at. Yeah. So where are we with that?
One of the things is if the dollar isn't doing well, gold is doing, usually is. So if gold was doing well, the dollar probably hasn't been. And that's certainly been the case. But if we look at just long term, the dollar is still near highs relative to where it has been in the past. It has been rallying the last couple of weeks, so there's been some strength, but we do believe that the dollar is moving into a declining market, and we'll probably see the dollar drop in value, which we think ultimately is going to be good for business in the U.S. We would be able to export more, but it comes at the cost of labor and our standard of living. We do think that because we import so many things, the dollar's low. We may be able to export and bring labor back here in the U.S. as it becomes cheaper, but our dollar goes, it doesn't go as far. So the cost of seeing that economic activity return to the U.S. is a cost of having a higher cost of standard of living.
So have we had any change in our investment themes?
No, our investment themes have been helping us throughout this correction. We are no longer bearish on commodities, but we changed that a couple of weeks ago. We're more neutral with commodities, and they have been performing, especially over this last week. Energy has been kind of rebounding. Lumber prices, other things for homes. There's a lot of material that has been increasing in price.
So how did they do on the relative strength scale?
The mid cap and small cap really did well over the last week. Technology's holding up, commodities off, and our gold miners are right there at relative strength. So we may be moving some of that exposure to the gold miners away. We have a decent spread. We've made a lot of money relative to the S&P 500 on the holding period. We like them as a diversifier, but we will follow our process. If it pushes us out, we will take what winnings we have and go elsewhere.
So let's talk again about political risk, because there's been a lot of political risk that's been affecting the market. We've got, 28 days now until the election.
Who's counting?
Or it could be 23 days, I'm not sure. So I just know it's coming up pretty quickly.
Yes.
How much of the political risk is priced into the market, and is there any other political action that could occur that could impact the market negatively?
So we believe that the political risk is not totally captured in the market, because a lot of the polls indicate that the the election of Vice President Biden is much higher than what we think is reality. His polls, by the way, at 4 weeks out, that positive 16, positive 14, this is the same number that was there for Senator Clinton, and she was later on to lose the election, as everyone is familiar with. So we don't think it's accurately capturing that, but we think that's to the upside, because if we do have a President Trump for a second term, and we kind of get that status quo, we think the market will appreciate that because of the likeliness of taxes and regulation being lower. Those, from a market perspective, are going to help asset prices. So we think that the upside is more likely than downside not being captured.
Let's talk about the coronavirus risk. It seems like the world has kind of settled down into this, whatever the normal is for at least managing the virus at this point. Mm-hmm. What is the risk going forward that could derail the market? Or is there one?
The more information we get, and this is very new, and we're also not doctors, but the World Health Organization actually came out recently. We haven't gone into the deep research. Don't know that we'll have time to get to it, and at this point, who knows who's accurate on this data. But they're actually speculating that there may be a lot more infections, 1 in 10 in global populations. Well, if that's true, then a 3% case fatality rate is too low. The risk of dying from the coronavirus is much lower than what's anticipated. But my pushback on that is we didn't have 60,000 deaths like a normal flu. We've had 200,000 deaths. Then the question is, well, is this actually a virus that just spreads faster? We think the answer is yes, it does. The flu that generates 60,000 deaths, the coronavirus is actually infected far more. So then once again, what's the risk? Well, the risk of me in 1 year, if I know that there's 200,000 deaths from the virus versus 60,000 deaths, I consider that far greater, and it's just a component of infection is more likely, so my risk may be lower from each infection, but my risk of getting the infection is higher. I know that's a lot to cope with, but at the end, I think we as a species have been dealing with these problems for quite some time. We'll figure out how to deal with them. There's going to be a lot of entrepreneurs that will figure out whether there's a lockdown or not on how to make things happen, and ultimately we will figure this out.
Well, there's a lot of change that's already happening, but I think that an interesting data point is the 1918 Spanish flu, mm-hmm. because it took 3 years and then it was gone. Mm-hmm. It doesn't mean that it was rampant all 3 years, but in other words, it's just kind of the cycle of it going through the population. So it wouldn't be unreasonable to assume that we could have something like that. There's some remnants of this that would continue on.
And remember, the 1918 flu was, the big areas that were impacted were the United States and Europe. China was not impacted, though it may have came from China. Well, what was going on during that time? You had World War I, so what was nutrition like? Getting back to the lockdowns, are the lockdowns having a similar impact where the nutrition is low, standard of livings are lower because of that? There's a lot to unpack there. We can also look at the data and say, well, the states with the more strict lockdowns had higher death rates than the states with less strict. But once again, is this the cart before the horse? Maybe you would have more strict restrictions if the impact is greater on the population. So it's too difficult to tell. And from a scientific method, we can do some approximations, try to use statistics to guess. But there's no way to take the same situation and say, well, here, let's just repeat the exact situation. It's like stepping in a river. You can't step in the same river twice, right? It's always flowing. It's always changing here.
So I think that the good piece of advice here is if they have a question about it, they should really speak with their lead advisor to find out what is appropriate for them and their circumstances right now.
Right, absolutely.
So tonight we have the VP debates.
Yes.
Do you think that'll have any type of impact or movement of the market? Is there anything new that we're going to learn?
I think it'll be easier to
actually
I think it'll be easier to watch than the last one debate. But
I sure hope so.
I don't think that the debate will have a meaningful impact on the election. It may be a much better way to get the perspectives of the two campaigns that are running without a lot of the crosstalk and banter going back and forth. Vice President Pence is a skilled debater, very much more mellow. It's going to be a different experience than President Trump. Kamala is going to be able to be very well scripted. She did well in the debates against in the primaries. So it probably is a great way to understand the differences between the candidates without having such the environment that we had on the previous
the
one.
wrestling match.
Yeah, the wrestling match. There we go.
I mean, I think that definitely this debate will be good for helping people to understand what the issues are and their proposed solutions, if they were, to be elected. So, but probably will not have an impact on the market. Now, we haven't really heard much about Russia. I did read in the paper today, in the Wall Street Journal, how Putin is striking out at Biden because he's so anti-Russian, which was kind of interesting. That's coming up right now on the front page. But are there any concerns that we have in the market from Russian activity or?
We don't really see anything. There are always problems politically with every country. I think the concerns on Putin poisoning people it's happened enough times that there's smoke, there's usually fire.
Probably something going
right,
on
there's
here.
probably something going on there, but we don't see it as a major impact. I think the big geopolitical component is Russia supplies Europe with a lot of energy, but that is a major factor or a major component to their economy. We don't see them cutting that off other than just a couple of hot spots or threats, nothing substantial coming out of that. And then you also have issues that are going on with Turkey, and there have been confrontations between U.S. troops and Russian troops. Hopefully cooler heads continue to prevail. I don't think Russia wants any type of altercation with any European nations or the United States. They certainly want to take advantage of the freshwater ports through whether it's Crimea or Turkey. They certainly have an interest to be there because if you take that area out, they don't really have access to the oceans year-round. So we do see them being a player, and then you have also the Belt and Road Initiative, where it seems that they've really, right now, the friend of your enemy is your friend. Did I say that right?
The friend of your enemy is your friend.
Or the enemy of your friend, however it is. China and Russia seem to be trying to have a stage in the geopolitics of the Middle East, as they always have. You can go back and read about the Great Game whenever Iran and Saudi Arabia and Egypt were all controlled by England, and as they went into Afghanistan, there's always this play. I'm trying to think of his name, but it's called Heartland Theory. It'll come to me, but an English person wrote it. It's always really interesting and really helps bring clarity of why there's always so much issues in both Israel and Afghanistan. We think that's just the way the world's going to work. So there will always be something going on around what used to be the old Silk Road.
Well, I think we are out of time today. That's been great information. We've got a lot of excitement going on that we can report on next week. But if somebody has a question or wants to contact one of our lead advisors just to learn more, how will they get in touch with us?
Well, they should reach out to their lead advisor. The phone number for the firm is 314-924-5100. Did I get that right?
5100.
5100.
Very good.
So reach out.
Fortunately, it shows on the screen so they can actually read it too.
There we go. There we go. So I would reach out to to a lead advisor if you're a client, your lead advisor. But if you just have some questions, absolutely give us a call. We're happy to take those calls, and we are happy to take those calls.
Absolutely.
It doesn't have to be a lead advisor.
Absolutely. And we also hope that you will continue to spread the word about us, subscribe, have your friends subscribe, because as you said in previous calls, that the more subscribers we have, the better the technology and outreach that we can actually have with YouTube.
Another thing that
fantastic.
we're hoping to roll out here soon is called the Daily 3x3, where we'll talk about 3 main topics throughout the day and trying to keep it to 3 minutes. So it'll just be a really quick video to help keep clients informed on what's going on in the market, how we see things, and what we're concerned about. So we hope to continue adding to the experience and being able to keep our clients better informed.
Better informed, and to make sure that we continue to bring relevant content to them today. So thanks again for joining us today. We look forward to having you back again next week, and so long for now.